Brett, we got Aaron on the line. What do you want to ask him?
What have you found really kind of the 2 or 3 most critical aspects of a market whenever you do market research?
I think most people will say that they're going to look for job growth, income growth, population growth, right? You're going to really want to find those things in that market. And not every market that we go into has all that. I mean, it should, but you just kind of have to pick and choose, and how confident are you in those markets? Because we don't typically go after like these primary or even secondary markets. Tertiary markets is kind of where you're going to have to start looking, because it's hard to find deals right now. But you just have to be confident enough in that market that you see in the long term that at least there's growth there.
Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Four Oaks Capital. We got another great episode coming up today. It's our Ask the Expert episode with 2 amazing people on the line. We've got Aaron Wong, another University of Utah grad. And if you're watching it on YouTube, flash the Ute hats and everything. And we also have Brett Davenport, who is, just a Colorado State University grad, but
Go Rams.
That said, guys, welcome to the show. But all right. So we typically lead off with our experienced investor and Aaron. So tell us a little bit about yourself, give us an idea of where you come from and, lead us up into how you got into apartment investing.
Sure. Appreciate the opportunity to be here. Said I listen to this podcast all the time, so I'm excited to be able to be here as well. I was born and raised in Salt Lake City, Utah. Went to University of Utah.
Go Utes again. Yeah,
absolutely. Go Utes. Anytime I can put that in there. Anyway, so, I got my education there, and probably really where I consider my real estate, experience starts coming from probably is in 2013 was when I was moved to San Francisco. And I bought a house. My wife and I bought a house out there. And it was, around 2013, real estate started getting kind of hot again right around that time. And so, we struggled to buy a house. It took us, almost a year to finally get a house in 2013. And so we bought it. It was definitely what we call now a kind of a live and flip. It was 1960, 1,200 square feet. Very expensive for, coming from Utah, where you're thinking real estate's probably not as expensive, but you come into San Francisco and you're looking at,
like triple the price.
Triple price. I mean, we paid now, it was $680,000 when we bought the house, which was nothing now.
Yeah.
It's more than double the price. But anyway, so it was a live and flip. We spent about 3 years renovating. I spent about 3 years working on the backyard and just kind of making it look nice. And then when we finally left, moved from San Francisco, we rented it out. So we kept it and just kind of as an investment property. And then we moved actually over to Guam for a couple of years, lived there, bought a house, bought some land. We're going to invest some make some investments out there as well. Because out there, as we all know, in the military, there's a couple of bases out there. There's a lot of need for housing. And so we're like, hey, this might be a great opportunity to be able to invest in here too. And so we did that, bought a house, bought some land, because at first we were going to build a house, but then that just kind of never happened. We're there for a couple of years, then moved to where we're at now, which is in Northern Virginia, and kept those as rentals. And then right around, I'd have to say 2019, we kind of made that decision on our house in California. We're kind of in that spot where we can get that tax benefit of if we sell it, if you live in it 2 to the last 5 years, you can sell it and then not have to pay tax. So we decided to do that, and made we felt very fortunate with what we got out of it. Pretty good money. And from there, that's when we really decided to say, thinking about investing. And, real estate investing had actually never really crossed my mind a lot prior. My wife actually was the one that really pushed me. She's like, we got to look into real estate investing. I was just like, oh, I've always been an investor in
Mm-hmm.
stock market, and I've been an entrepreneur, kind of investing in businesses, but never really into real estate.
Mm-hmm.
And so it was right after we sold this property, we're just like, you know what, let's start looking into investing in real estate. And so that's when I found, I would get onto the podcast, listen to a lot of these, I was really into like the FIRE community, financial independence, retire
early. Everybody wants to do
not
that,
really
right?
the retire early part, but more financial independence, right? And so I really liked those concepts. And so that's when I started to hear a lot of people talking about real estate and bigger pockets. And that's where I got started was, I jumped on a bigger pocket, started reading a lot about bigger pockets, and it's like this, real estate actually might be able to do this. And I went to one of Brandon Turner's webinars, and he really pushed multifamily, and that's when I was like, okay, if we're going to do real estate, I think we should do multifamily. And so that's right then and there we decided, and then I think it was right around the end of 2019. We bought, we put offers on properties in Dayton, Ohio, and St. Louis, Missouri. So we pretty much bought and closed on through 12 units at that point, because we wanted small multifamily. So it was a fourplex, 2 duplexes, and another fourplex in St. Louis, Missouri, all within about a month of each other.
Nice.
And so looking back now, we're probably like, probably should have went with one first, but hey, we had found an opportunity. We thought it was a good opportunity, and we just went for it. And
now, were those all self-funded, or do you guys have partners on those?
All self-funded. All those were self-funded. We bought with cash because of our
San Francisco house, right?
Our house in San Francisco. We sold it, and we're just like, let's go all cash. And then, because, we didn't really think much about leverage. I mean, that's another concept, another thing that we probably should have thought more about.
Yeah.
And so we're just like, let's buy it with cash. And so we bought that. So we got those 12 units under wraps within a month of each other, all, rather than at the end about 2019. And then it was about probably now COVID hit, right, in 2020. And then we went back to Utah to visit family. And at that time, I went and visited a friend of mine, and he and I, probably about 10 years ago, we had worked together, and we've always talked about doing business and trying to figure out, different business ideas. And so we had dinner, and we were just talking, and I was telling him, what I was doing, just getting into real estate, and bought these 12 units, and it's cash flowing. This is what is cash flowing for me right now, and it's it's been fun. And then he's just like, man, I really want to get into, real estate. And, and now that you've talked about this, this is something I feel like I want to do, because at that point, he's just been kind of like trying to figure out kind of what's next for him. And so, we decided to start working together on trying to build a real estate portfolio. And we didn't really think much about really like syndications or anything like that, but just buying property and then just going after it. At first, it was just still, again, it was like small multifamily. So after we decided to partner, we immediately closed on a 12-unit property in Dayton, Ohio. And then we closed on another 4-unit and then a duplex right after that. And then at this time, I'm still looking for stuff for myself. And so I also closed on another 4-unit in New York, in upstate New York, and in Niagara Falls. And so, that's so then we started coming together, towards the end of 2020. We're just like, we should start looking at stuff bigger, because we figure, we're hearing a lot of people saying, it takes about as much time to work on kind of larger properties than it is on smaller properties. So we started looking, and that's where we started looking for things bigger. Like we're like thinking maybe let's go for like a 40 to 60 unit, because that seems like a pretty good sweet spot for us.
Nice entry point for a lot of people.
Yeah, exactly. And we thought that would be great. And so, we got a property under contract in Oklahoma. And then, as we were flying out there to really do the due diligence on the property, one of the property managers we were actually working with had mentioned about another 200 unit that that was out there. And because, I was just telling her, I was like, hey, we're looking, this is the types of properties we're looking for. So if you know of anything else, let us know. And just kind of telling everybody what we're doing. And so she mentioned there's 200 units. She says, well, you're out there, you should go check out those 200 units. And so we walked this 56 unit that we had under contract. And then eventually it didn't work out for specific negotiation, just didn't work out. They weren't willing to come, just meet us where we needed it, just because it was a lot more distress than we expected. And then we just basically had to walk away. And then we're like, hey, there's this 200 unit. We walked it, and we're like, we really like this property. I mean, it was, looked much better condition than this 56 unit. And so eventually, we put an offer in, got it, and then, it took us almost 4 months to finally close, but we eventually closed on it. So that's kind of what took us to apartment.
Nice.
That's where we're at now.
So playing Mythbusters with you, you said something earlier where you heard that, buying a large property is about the same amount of work as buying, the smaller properties. True or false? What do you think?
I would say it depends, right?
Okay.
I would say
Fair
it depends
enough.
on the size of your property. I think maybe something a little bit smaller. Maybe a 40 unit might be just as easy as closing a 12 unit that we had. I mean, we haven't really had that experience quite yet. I mean, because we went straight to 200, and 200 is much different than what we had, right? So, and that was a lot of challenges, which we could definitely talk about, and we learned a lot from that one.
Well, what I always say is I say, 1 to 100, in just door count or numbers is 100 times more, but it's not 100 times more difficult. It is more difficult. And that's an absolute. It is more difficult to close on a large multifamily than it is on, single family. But I guess maybe the best way to phrase that question is a 200 unit easier to close on than 54 plexes or 20 10 plexes? And that's really the more fair question. So
I would think that probably a 50 unit versus 450 units versus a 200 units. I would think the 50 units would probably be easier, in my opinion, just because when you get to that size of 200, you're looking at different types of financing, and the lenders are a little bit different, and the scrutiny that you go under, it could be very difficult. Like we had a lot of challenges on this 200 unit. And a lot of it came from our lender. I mean, it was a challenge, but we made it.
That's something that I think I've definitely said this before, maybe not on the podcast, but the lenders control the market more than any other entity, because they're putting the most cash in. And if they're going to give 8, 10, 12, or $15 million to a group to purchase a property, they're dictating the terms, and so a lot of times, you're almost beholden to the lenders, to get your deal done, so if they say jump up and down and pat your head at the same time, I mean, that's what you do, right? So
absolutely.
But
and they know it.
They know, absolutely.
They know
do.
it. They absolutely know that they control the deal. And there are things that we had to agree to. We're like, because they knew that they had the control. And it's if you want this deal done, you got to do what you got to do. You got to do it this way.
Fortunately, they also want to do deals. And so, at some point, a lot of times common sense does prevail. Because the broker, the lender doesn't get paid until you close a deal. They're going to get the funding fee and a bunch of other, commissions in there. But fortunately, your interests align to the point that you all want to close the deal. Obviously, you've got to get over that hurdle. But I love the story. I mean, you went from slowly kind of built that portfolio. And I mean, when you went to that 100, how many units did you have? I lost count, somewhere around 30, maybe 40.
It was around 30. We had just a little over 30, but we've closed in probably a little over almost a dozen different deals,
Okay.
So,
all right. How much that 30 units help you out in getting the 200? I mean, was that crucial, or do you think you could have skipped that step?
I think it helped. I mean, it helped. Luckily for us, this was a purely off-market property. Like you hear a lot about off-market. Like I don't think any property is truly off-market anymore, right? Even though they say off-market. This one was truly, truly off-market. And I think if this thing got marketed, there's no way we would have gotten it. But it helped because we were able to send them on our REO and just say, hey, we've got this type of experience. At least they saw that we have experience and that we got some loans and that we know what we're doing. And so, yeah, I think it helped. It definitely helped that we had experience.
Awesome. Well, one question, slightly shifting gears a little bit here. I want to know what motivates you. What is your big burning why?
So I think, you hear it a lot on your podcast. It's a lot of family, right? That's one of my big burning whys is, I want to be able to create an opportunity where, to be able to take care of my family. And, my wife works. We have a young son that we adopted a year ago. And, just being able to spend time with him and being able to spend time together as a family, I think is really important to us because, I've always traveled a lot and, worked long hours and just being able to eventually get to that financial freedom. Hence why, I tried to pursue that, the fire, right? The financial independence, because we want to be able to get to that. And that's definitely one of our big burning whys is just being able to spend time with family, give opportunities to our family, our son, to be able to do things that, give them all those opportunities that he would want to have. And another one is, is just be able to make a positive impact on in the communities, especially the places that we invest in. That's really important to us. Wherever we invest, we try to improve the place, not only the apartments, but through rehab, but the community in itself and those tenants. We want to help improve their lives. So that's important to us.
Yeah, that is an important. I mean, the more win-win wins you can create, the better. If you come in and you make a community better, you make a property better, everybody wins. And the nice part about this business is it also helps your bottom line as well. So building communities, making apartments better, putting money into communities. I mean, I'm sure your renovation budget on a 200 unit is going to be, probably a 7-figure budget where you're putting 7 figures into the local economy, into people's jobs, into people's back pockets. So, and you're making a place a lot nicer. So lots of goodness there. So one question I'd like to ask everybody, Aaron, what's next for you?
So, we're going to continue doing what we're doing, try to continue finding more and more properties to be able to close on. I have my partner who is, he oversees all the acquisitions. And so that's kind of his thing, just to find properties. And I'm working a lot more on trying to build relationships with other operators, also build content. So, we just started a blog recently, and, just trying to put more content out there, not necessarily for operators, but for like passive investors. That's really what my focus is on, is trying to help passive investors kind of see opportunities in real estate. That's really the theme.
Yeah. I think there's a lot of people that don't understand this is even available to them. A lot of people are following the traditional financial, 401k, stock market, ETFs, blockchain, whatever the latest thing is. But syndications don't seem to be, mainstream yet. They're getting there, but yes, but not yet. So
exactly.
Well, that said, we're going to shift gears right here and introduce our next guest. So Brett, welcome to the show.
Thanks. I appreciate it. Thanks for having me.
Yeah, not a problem. Thanks for being on the show. So do us a favor, tell us a little bit about yourself.
Sure. So again, my name is Brett Davenport. I'm with Gibby's Capital Investments. I actually came to real estate after a long, drawn out process. So when I was active duty Navy back in the 90s, I had a friend of mine that was pretty active in the stock market. And he came to me and he's like, hey, I have this great idea. I found this new startup company and you can buy several shares of stock for $1,000. And I really think it's going to take off. And number one, it was back in the 90s. I was in E5 in the Navy, so I don't know what made him think I had $1,000. But number two, I thought the name of the company was stupid. So I was like, nah, I'm not going to do that. Well, as it turned out, the name of the company was Yahoo. So I missed out. I missed out on a pretty significant opportunity because I didn't really have much of a financial education and I didn't know anything about investing. So ever since then, I've been kind of looking for something that we could get into that would, provide that same kind of financial security that, that we could really lean on and get me out of my W-2 job. So last year, my soon-to-be son-in-law and daughter actually came to visit, and we started talking about something that he had just gotten into. And he started talking about two gentlemen. One was named Tyler Devereaux, and the other one was named Ryan Woolley, and they started a company called Multifamily Mindset. And my son-in-law had been in sales for pretty much his entire adult life and was always very successful. So the fact that he told me that he had found something that he thought was really positive kind of piqued my interest. Well, also at the time, my wife Megan, who also owns a golden doodle breeding business, was getting ready to sell a litter, which was going to be, some pretty significant cash flow. So after my conversation with Eric, I went and I said, hey, all those credit cards we were going to pay off, we're not doing that. We're going to do real estate. And she kind of looked and thought I was a little bit crazy, but she said, okay, well, why don't you tell me about it? So I did. And a few months later, we formed Gibby's Capital Investments and got into multifamily real estate.
Okay. I didn't know Eric was your soon-to-be son-in-law.
Yes, he is. Eric Chatterton.
That's okay. Yes, absolutely. Yeah, I sat down with him in Dallas the weekend that I was there. And for some, I don't know why we weren't able to connect. I remember reaching out, but I don't remember what happened. But I knew you guys were connected in the company. I didn't know he was your soon-to-be son-in-law. That's awesome.
He is. So, he is engaged to our oldest daughter.
All right, that's great. So I really like him. He's a good dude. So
he is a great guy.
Yeah. So I'd be happy. And incidentally, my oldest daughter got married about a year ago. She's also the podcast editor, and she landed herself a pretty good dude too. So nice. I've been in those shoes already. But anyway, that said, looking at, you talked a little bit about it, you kind of wove it in and out a little bit, but if you could distill everything down, your motivation, what is your big burning why?
I've listened to your podcast for a long time, and I've heard a lot of people talk about their whys, and from kind of a high level, mine is similar. It's time freedom, it's the ability to do things with my family. And make our own choices without that, that restriction of trying to find ways to finance it. But if I get right down to it, ultimately it's the ability for me and my family and our organization to affect other people's lives in a positive way, which sounds kind of corny. I get that. But, there's a poem about everyone's dash. And it's referring to the dash between the year that you were born and the year that you died on your headstone, and how your dash, affects other people's lives and the positive impact that you have an opportunity to have on other people. And, I read that poem several years ago, and it had a real impact on me and trying to find ways to positively affect other people. And with multifamily real estate, we not only get a chance to financially bless other people, to give back to causes that we believe in, but also, for every multifamily property that we own, we have an opportunity to affect potentially hundreds of families and how their lives are affected, and the positive impact that we can have on them and their families. So it really kind of provides an exponential opportunity to have a positive impact on the world.
Nice. Yeah, very, very much. I think you're right. That's a lot in line with a lot of people say. And yeah, the dash poem, that's one that hit me when I first read it too. It's the most important part on that headstone is the dash. What did you do between birth and death? And it's you want to leave a legacy for a lot of reasons, and giving back, helping other people, that's the way to do it. That's the way to be remembered. And incidentally, my wife and I were talking about like the Day of the Dead, which is a Latin American holiday. And that's what a lot of it's about. It's about remembering, the impact that other people have had on you. And I think it's a very, something that a lot of people feel the same way. They want to have that impact. They want to be a force of good for other people in the world. So very much appreciate you sharing that. That's
you bet.
Anyway, so here comes the fun part of the podcast, where I get to say, Brett, we got Aaron on the line. What do you want to ask him?
First, I just want to say, Aaron, thanks for taking some time to invest in, rookies like myself. I really really appreciate it. I was curious, what was one of the biggest mistakes that you think you made when you were starting out? And if you could go back and change that mistake, what would that look like, do you think?
I think one of the biggest mistakes, when especially when you're getting into multifamily, is there's always the thought of do you try to find deals, or do you try to find the money, right? I think that's for us, we were just so focused on trying to find deals that when it came to actually we would find deals. But then it's like, now how are we going to finance this thing, right? There's always this debate that you hear that people say, if you have a deal, the money will be there, right? And so it's not always true. And it's always an interesting debate that people have. But one of the things, if I could go back, is I would absolutely 100% start trying to raise money right now, even though you don't have a deal. Just talk to people, get soft commits. Just tell people what you're doing, and just say, and even if you have to create like some type of a deal package, a sample deal package, a little bit about yourself, a little bit about what a deal would look like, give it to them and just let everyone know about it, so that you can start getting some soft commits, so that when you start moving forward, it's going to be easier to raise money, because you will need to raise money for stuff like this.
Right, absolutely. And speaking of deals and money, I read that you've done joint ventures and syndications. Can you explain a little bit what the difference is, and what there might be an advantage of one over the other, if you think there is one?
Sure. Yeah, we've done a couple of joint ventures. I think the biggest difference between joint venture and syndication is a lot of it's the number of people you can bring in to invest. Right, with a syndication, you're going to have you'll have a lot of limited partners, a lot more than you would with a joint venture. With a joint venture, typically it's going to be a smaller group of people investing, and everybody needs to have a role. Because if someone doesn't have a role, then it's going to be a syndication, and you have to be really, really careful with people not having roles, because you got the SEC that's going to come down on you if they find out this person's not doing anything, but he's because they can't just be capital raisers, right? You can't just have someone just bring in money. Everyone's got to have some type of a role and do something. Something else that I've noticed with our joint ventures anyway is typically with a syndication, we've had to bring in more or less money to the deal, right? With a joint venture, because our joint ventures typically have just been like with one or two other groups, we have to bring in more funding and more cash to the table. And so, it's, if you go through the syndication method, you can probably bring in a lot more people and bring a lot more money. So that's our basic experience with joint ventures and a syndication.
Excellent. Thank you.
Yeah.
And this is a kind of a question for both of you. When it comes to scaling your business, what would you say have been your most critical systems that you put into place that really helped you to grow consistently?
Guess I'll go first.
Yeah, I can take that. I got something right on top of my
Go for
tongue.
it.
Yeah. So I'm going to go back to what Aaron said up front. Our first capital raise was extremely difficult, right? And we were at one point, a couple of weeks from closing, wondering if we were going to have enough money to close, right? So I would go back to what Aaron said earlier about be raising capital. It's not if you have a good deal, the money will come, because we had a good deal. What's helped us to be able to scale is, and Aaron already alluded to this as well, the syndication, you can bring more money to the table and get more deals. But what enabled us to scale in a large part was our capital raising arm. Being able to bring more money to the table has helped us to get into bigger deals. And, that's one of the big pieces to scaling, is how much capital can you bring to the table?
Mm-hmm. Yeah, absolutely. I think some other systems that, that we have you ever read the book Traction? You're
Yes.
familiar with that book?
Yes,
this
actually,
right here.
just
Actually, I have it.
Yeah, just read it a few weeks ago, actually.
You can't really see it through my Traction. Anyway, it's an excellent book about creating systems. And, from day one, my partner and I, we decided we have to treat ourselves as a business, as like, if you want to be a $100 million business, you got to act like a $100 million business, right? So Traction is really good because they have this EOS system called the Entrepreneurial Operating System, which kind of helps you build systems around your entire business. And, and it's very systemized. And I really, when we follow it, even though it's just, the two of us as partners doing a lot of this, and we have other people helping us do other things, but just being able to follow the systems that are developed in there, through meetings and just being able to basically have checklists for everything. I think it's really helped us, at least, to be able to stay organized and to be able to continue to, focus on what's most important and doing those most important things instead of just running around with our head cut off. Right.
Right. Yeah. It's funny. That book was actually the genesis for the question about systems, because Megan and I read that book.
Yeah.
And
it's an excellent book.
Same thing. Yeah. Same thing. Great for book. Systems.
Well, my monthly Audible credit comes in tomorrow, so I think I might be pulling that book out. So
great. It's a good book.
Yeah, absolutely. And then also back to kind of finding deals. What have you found is really kind of the 2 or 3 most critical aspects of a market whenever you do market research?
Well, for us, I think there's generally, I think most people will say that they're going to look for, job growth, income growth, population growth, right? You're going to really want to find those things in that market. And so when you start researching a market, you're going to want to have at least those are the 3 things that we look for. And not every market that we go into has all that. I mean, it should, but you just kind of have to pick and choose, and how confident are you in those markets? Because we don't typically go after like the primary or even secondary markets. We'll try secondary markets, but especially in this market nowadays in the real estate, tertiary markets is kind of where you're going to have to start looking, because it's hard to find deals right now. So we have to go there, and you're not always going to find all 3 of those growth. You're not going to find all that all the time, but you just have to be confident enough in that market that you see in the long term that at least there's growth there.
Right. Yeah. Fortunately, with us living in Houston, the Houston metro area is the size of Connecticut. So we're fortunate that we can find deals here. We just have to be able to drive or be willing to drive a little bit. I mean, I live on the northwest side of Houston. We have a property under contract actually now on the southwest side of Houston, which sounds really close, but it's still like 45 minutes. So
yeah. Yep. That's great.
There. Yeah, I was just going to say the same thing. So we also have been looking in the tertiary and secondary markets. There's a little less competition. You can get, the pricing isn't quite as competitive. And, I think there's a big push from the urban metros to the tertiary markets. A lot of the money is moving from, high population density to low population density, and it doesn't mean that the high population density areas are going to do poorly. I think our population is increasing fast enough that, you can still do well, in the urban areas, but you're seeing places like, where I live, Idaho Falls, a true tertiary. You're seeing places like, Killeen or Abilene, Texas, true tertiaries outside of the, the Dallases and the Austins and everything else. they're actually doing extremely well. So you can find the little gems here and there. You just have to, like Aaron said, you gotta really know the markets. You got to understand the dynamics, what's going on, and where the safe investments are.
Yep, absolutely. Okay, next question. With the changing political landscape and the possibilities of changing tax laws, because that's one of the things we like to talk about whenever we talk to investors or potential investors, is the tax advantages of large multifamily real estate. Do you see like the potential loss of 1031s or anything else that jumps out at you that really is going to kind of change the conversation or the dynamics around multifamily real estate investing?
Well, I mean, not until it actually changes, right?
Yeah.
I mean, there's always that discussion. I know, Brian, it looks like you have something you want to say.
Yeah, I was going to, but with 1031, I mean, the major players in the market are going to figure out a way to get around every rule. I mean, you take a 1031 away, you still have an installment sales trust that can do almost the same thing for you. So if they take away a 1031, I don't think, there are going to be individuals that are impacted, people who are like, dang, that was my plan. But there are other vehicles and other ways to legally, defer taxes or just not pay taxes, So what I would say is I think that, any of these looming changes could have a short-term impact, but the market's still going to do well. The market's still going to move on. It might be a little bump, may make a little rocky road for a little bit, but the other fundamentals are secure, So 1031 specifically, I don't think there's a big deal on that one. There's also something in Congress that's going to shake up, how a 506C and SDIRAs work out. It doesn't change the dynamics between a 506B and SDIRAs, but once again, it's something that people are going to be able to figure out workarounds.
Yep.
So if somebody with a 7-8 figure balance sheet is looking to diversify, it just means that now my SDRA is parked in, market assets, and my, play money or my other investment money outside of my retirement plan is going to be parked in the real estate. So I really don't think it's going to make a huge difference, is my answer.
Awesome.
Yeah.
Agreed.
So, yeah. Boom. All right. We got time for one more quick question if you got one.
Sure, I do. So what are, speaking of talking to investors, what are some of the top investor objections that you've heard of that a syndicator should be prepared to answer before getting on a call?
Well, one big one that, when we were doing our recent raise, one big one that I would get every once in a while, which was kind of weird, was, well, it's not really weird. It's just like, is it safe to invest with you guys, right? You hear about like Bernie Madoff and people running away with money. That was always an objection that we'd get. It's like, how do I know that I can trust you with my money? I mean, think about it. $50,000, $100,000. It's not a lot of. It's a lot of money, and so, how can I trust you to do well with my money, right? I think that's one of the big objections, and the underwriting. Can you get these returns that you're actually saying? And this is one thing that I harp on a lot is, this term of conservative underwriting. And I think it's just thrown around just so easily nowadays that everyone talks about, I do conservative underwriting, but really you got to look at the underwriting and know, is it really conservative? I mean,
right.
and have your own definition of what conservative is, because I think it's very subjective. But there's definitely underwriting I've seen out there that they say they're conservative, but there's no way it's conservative.
I've seen some aggressive conservative underwriting, is what I've seen. But, I would say the questions that we've received have kind of changed, up front. Most of the questions I had were related to our experience because we didn't have any. And that was the biggest thing that, people would look at us and say, well, this is your first syndication. Just like Aaron said, how do I know? How do I know? The other big question that we get a lot usually has to do with the economy, and they're what if questions. When we started syndicating, 2-3 years ago, there was a big thing about the yield curve being inverted, and, we're going to go into a recession, and it's not if a recession comes, it's when the recession comes, so, we had to basically look at what the concerns were on the larger market, so, and like I said, at the time it was, yield curve and recessions. And, so what we did is we looked at, what's on the horizon, what's on the foreseeable horizon, and nobody can foresee COVID, but what's on the foreseeable horizon and how do we mitigate risks? And the more I think about it, I think the answer to that question is go into your deals with as much flexibility as possible, so,
Right.
And you asked Aaron up front, what was one of the things, maybe his mistakes that he made. On our very first property, we got into a loan that is not very flexible at all. And we got a 12-year loan because a lot of people in, like I said, 2018, 19, were talking about that recession that's coming up. And our answer to the recession was long-term debt, but
Right.
Now we're into a loan that's not very flexible. The property is still performing, but we don't have any flexibility to be able to sell. So, there's a lot of the questions are either going to be, for you up front, your experience level, so you're going to have a good answer to, hey, we don't have experience, but we're partnering with, that usually helps. And like I said, the other questions are usually what if, what if the economy goes south? What if rents? What if, the place burns down? So just look at a lot of the what if type questions that you can possibly get, and be able to have a good answer. Insurance policies mitigate a lot of risk, so be able to answer a lot of the common what if questions. All right. That said, we are just about out of time. So I got one question for each of you. Aaron, you get to go first. How can listeners learn more about you?
Yeah, so you can go to our website. It's www.gwcapitalinvest.com. You can also reach out to me. My email is Aaron, AARON, @gwcapitalinvest.com.
All right, sounds good. Brett, same question for you.
Sure. You can go to our website at gibbyscapital.com. That's GIB as in boy, BYS.com. Or you can also reach me at brett@gibbyscapital.com.
All right. And we'll have that information in the show notes, to be able to contact both Aaron and Brett. And if you're watching this on YouTube, really simple, you just got to look at Brett's screen because he's got, Aaron's got his company in the back too. His big Utah awesome hat.
Right.
Awesomeness is blocking it. But that said, guys, thanks for being on the show today. Really appreciate your time, and we'll chat soon.
Thanks, Brian.
Thank you.